Well, ever since COVID, like my God. Oh, Wally.
Eric had a full ride at OU, and then he had a full ride at Penn.
Oh, that's fantastic.
Yeah.
My goodness.
Yeah.
We had all this money saved
Like my
up.
wife.
Wonderful blessing.
Are we good as far as quorum? Are we good for quorum? Well, good morning, everyone. The lights have turned on, so that tells us it's 10 o'clock, and it's time to call the February 10th, 2022 meeting of the City Retirement System to order. Item number 2 on our agenda is to approve the minutes of the meeting of January 13th, 2022. Have a motion and a second. Please record your vote.
Carla, were you able?
Mine's got
Yep.
a yay on it.
Item is approved. Item number 3 is the consent docket. We have one item. Have a motion and a second. Please record your vote.
You can vote yes, Carla.
Yes, she's not working.
Oh. Sorry. Sleep at the wheel there.
Item is approved. Item number 4 is to ratify approvals. We have 3 items. Have a motion and a second. Please record your vote. Item is approved. Item number 5 is to approve the claims docket. Have a motion and a second. Please record your vote. Item is approved. All right, now I'm having technical difficulties here. Item number 6 is to approve the following applications for service retirement. Have a motion and a second. Please record your vote. Item is approved. Item number 7 is to receive report of death, authorize payment of $5,000 death benefit, and approve continuation of pension to spouse. Have a motion and a second. Please record your vote. Item is approved. There we go. Item number 8 is to receive report of death, authorize payment of the $5,000 death benefit, and authorize secretary to make necessary changes to conform on the following. Motion and a second. Please record your vote. Item is approved. Item number 9 is to receive report of death, authorize secretary to make necessary changes to conform on the following. Have a motion and a second.
Trustee Janata, how do you vote?
Yes.
Please record your vote. Item is approved. Item number 10 is approve the following applications of vested rights. Have a motion and a second. Please record your vote.
Yes.
Item is approved. Item number 11 is to receive investment consultant report. We have 3 reports.
Good morning, everyone.
Good morning, Jason.
Yeah, you have, I'm going to go over a few things this morning. The quarterly report, I'll touch on the monthly update, and then we're going to review asset allocation. Then I also put a loose piece in there that says equity long-short discussion, which is I'll touch on that as part of the market overview. If you could just turn to page 8 in the quarterly report, touch on a few things in the market. I know I talked about this a little bit last month, but I want to highlight some things because as we look at performance, we'll see some of this flowing through into the numbers. But what you'll see here, and this is focusing on the year-to-date and the 1 year is the same time period. That's calendar year 2021. Looking at the S&P 500, you see it's up 28.7%, so very strong return for U.S. large cap equities. What we're not really seeing in that number is that was really concentrated in a handful of names. The top 10 stocks, the FANG stocks predominantly made up about 2/3 of the return during the year. As you drill down a little bit, looking at the dispersion between large cap and small cap, pretty big in the calendar year. So Russell 2000 up about 14.8%, still good on an absolute basis, but about half the return of U.S. large cap. If you turn to the next page and just look at it from a style perspective, huge dispersion and rotation in small cap between growth and value. Small cap growth up 2.8% on the year, small cap value up 28%. Really what we're started to see in the second half of the year is that rotation out of growth and into more less inflation sensitive securities and value really outperforming in the second half of the year. If we think about 2020, small cap and growth really outperformed. And as we looked at your overall portfolio a year ago, while the numbers this year on an absolute basis are still very good, over 10%, we're trailing the policy benchmark a bit. At the end of last year, we were way ahead. And that was the small cap, and particularly within your large cap portfolio. And what do I mean by that? Your large cap allocation is predominantly benchmark risk controlled. We have the S&P 500 index fund, which is going to mirror the index. And then we have Intech, which is a quantitative strategy that's going to own the names in the Russell 1000 large cap index. But based on their approach, it tends to overweight the smaller names, the smaller capitalized names within the large cap index. So when smaller cap is doing better than the mega cap names, that strategy outperforms. And that really was a positive in 2020, and it was a bit of a negative in 2021. The other areas that certainly led to some dispersion this year, and you'd say looking at the month of January, certainly disappointing, is long-short equity. We talk a lot about how the long-short equity over the long term is designed to provide some hedge against equity market volatility and protect in down markets and participate on the upside. Over this short period of time, the last 3 years, you've gotten most of that, although I'd say the last several months, and really 2021 as a whole, was pretty challenging for long-short equity managers because of 2 things. One is this lack of breadth in the market, and that piece that I handed out that just says equity long-short discussion, I'll refer to that. This first slide is just showing depicting what I just described. As far as both the S&P 500, which is U.S. large cap, and the MSCI Aggregate, which is a global stock benchmark, really driven by a handful of names. So the S&P 500, there's 500 names. That's easy to understand. Top 10 holdings, meaning the top 10 largest companies in the index, accounted for 2/3 of the return. So that 28% return that you saw, 2/3 of that was from 10 names. So more fundamental oriented managers are spreading their bets a little bit wider, not just having a lot of concentration in those names. We should see that benefiting coming into 2021 as those names have really sold off. The same is true for the global benchmark, which long-short equity, we compare longer term to a global benchmark. It's not going to track that benchmark in the short term at all. That's not what they're doing, but they are investing in stocks globally, both long and short. The MSCI All Country World Index has over 10,000 stocks in it, thinking globally. This is primarily a mid to large cap index, so not a lot of smaller cap exposure. But within that index, 100 stocks, or 1% of that index, made up about half the return for the global index of the year. Again, very concentrated. So that lack of depth in the market really was a headwind for fundamental managers that are stock picking, tending to skew toward smaller to mid-cap names, which was an impact. The other thing as we think about more fundamentally oriented managers was the quality impact. This really was in the first half of the year, and we talked a lot about this. When we talk about quality in equities, it's a little bit different than quality in fixed income, but essentially stocks are rated, are given a quality rating by S&P, and it's based on a number of metrics, but it's primarily consistency of earnings. So how consistent do those companies grow their earnings? In the first half of the year, the best performing stocks were companies without earnings, companies that were on the brink of bankruptcy and really not doing well, thinking of the BlackBerry, GameStop, AMC Theaters, things like that. This chart at the bottom shows the dispersion between low quality stocks, C and D rated stocks, and higher quality companies, the companies that have consistent earnings growth. You'll see that that dispersion was the highest that it's been since really the tech bubble in the late 90s. And that was a major headwind for fundamental stock pickers. And what we actually saw, there were periods, a few months in mid-2021 at the peak of this, it started to abate later in the year, where long-short equity was actually down when the index, the global index, was up, because shorts didn't help. Shorts actually hurt. If you're shorting those names of companies that didn't look very attractive on a fundamental basis, you're getting hurt. And so that was a headwind, and not owning those names long was a big headwind. So I think this is important just to understand what was going on in markets for the year, because it looks pretty challenged. The next page, we're just looking at the long-short equity since you've transitioned to the Mauna Kea platform, which is a little bit different implementation that you had before, and looking at that since 2018, 3.5 years on a calendar year basis. What we show here on the left is our intermediate term assumptions from an asset allocation standpoint. But it's not up here. I'm looking at this slide just in case everybody. Our intermediate assumption for the next 5 to 10 years for long-short equity is 5.7%. For global equities, it's 7.9%, which our expectation is about 72% of the return. And then the bottom assumptions are the volatility assumptions or risk assumptions, with about 65% of the risk. So that's what we're expecting longer term. And as we think about what we've done, and we'll talk more about asset allocation today, over the years, we've really because yields are so low and you need a 7% return over time, we've been taking from fixed income and adding to equities. But long-short equity is a way to have equities, but not have all of the risk of equities over longer periods of time. So it's designed to provide a buffer. So we're giving up a little on the return side with the expectation that we're going to give up a little volatility. Over the last 3 years, it's been 3 very strong years for equity markets. 2021 certainly didn't get that for the reasons I just described. Down 1.5%, the global long-only benchmark up 19, and that's primarily for the reasons I described. 2020, if we look at those 2 years together, some of the things that hurt this year helped in 2020, leaning a little bit more small cap, leaning a little bit more growthy. That was a huge year. We wouldn't expect for long-short equity to give us 150% of the long-only benchmark, but we got it in that year. The 3.5 years that you've been using Mauna Kea, we've got about 9% return versus the global benchmark of 14. That is maybe a little bit lower, but it's in line with what we would expect, with about 70% of the volatility, a little bit higher volatility, and a lot of that is from this year. So I thought that just as looking at that long-short equity, particularly in a month where markets are down like January and our long-short equity is down 7%, these are the things that are going on there. We're having regular conversations with these managers, and they're not selling out of positions. They're very convicted in positions that fundamentals are strong. We really haven't seen a period like this, like I said, since the tech bubble burst. And what we saw following that was a pretty sustained period of fundamentals coming into play, active management value outperforming for the next 5 to 6 years. So I thought it would be helpful just to highlight some of this as we look at these numbers, because it certainly stands out. If you want to flip forward back in the quarterly book to the page 20. If we look at actual dollars, pretty remarkable how much the portfolio has grown, and this will tie into the asset allocation discussion we'll have in a moment. But looking at the last 10 years, this would be from 2011 through 2020, end of 2021. The beginning market value, I guess that would be the beginning of 2012, was $494 million for the retirement plan. Your net additions or net cash flows, negative $219 million, $219.4 million, so that's benefit payments and contributions in, less benefit payments and other expenses out. The portfolio has grown by $686 million over the last 10 years, so very strong results. Going forward, as you'll see, and you've recognized this, by even as strong as your results have been, you've been very diligent in lowering your return assumption, because we're not at the same point we were 10 years ago, where yields were higher, valuations were more attractive, so the opportunity going forward from then to now was much better. Today we're in a much lower yield environment. Equity valuations are much higher, so being realistic is important. So I point that out. This has been a great 10 years. The last 3 years, 2019, 20, and 21, that's pretty remarkable to think about what's gone on in that 3-year period. Most of that has been the COVID pandemic and lots of concerns going on globally. The portfolio has grown by almost 370 or 365 million over that time period. The next slide just looks at your intermediate to longer term results relative to objectives. This is really, for a pension plan, this is really the way we should be looking at things, not month to month, quarter to quarter, even year over year, but longer term. And what we've tried to do is design this portfolio to meet your return objectives over time, but do so with a little bit less risk than the broad markets, protecting in down markets and participating in up markets. So these statistics bear that out over the 5 and 10-year period, well above that your current assumed rate of return hurdle of 7%. You've brought that down, as I said, diligently over this time period, but certainly the last 5 and 10 years, you've exceeded that significantly. And we've done it with a little bit less risk. and also outperforming the policy index, which is a measure of the asset allocation. The portfolio, both on a 5 and 10-year basis, we've outperformed that. And you've done it with a little bit less risk. So just moving forward, perhaps looking at the January report. Sorry, I'm looking up there because I can see that better than this without my glasses. I can't. So at the end, January was a rough month, as you all know. Portfolio was actually down about 4%. That brought the trailing one-year return to a little under 8%. As you'll see here, the things that I mentioned, particularly your large cap allocation, which is the largest allocation in the portfolio, down more than the benchmark, and that's having a little bit, the Intech strategy is more exposed to smaller names in the large cap benchmark. And long short equity had a really rough month. 3, 5, 10 year still outperforming benchmarks. Can you go back a slide? I'm sorry, to the asset allocation. So just in terms of asset allocation, we're essentially in line with targets, 65% in equity, pretty much in line with the exception of private equity. Private equity is about 3% underweight, and you increased your private equity allocation last year when we adjusted your long-term strategic asset allocation. We lowered fixed income overall by 5% and increased equity by 5%. Within equity, it's private equity that we increased by 5% to over the intermediate to longer term going forward, looking for areas where we can boost return a little bit, that there's potentially a little bit more opportunity. For that liquidity give up, we expect to get a little bit higher return. And as a pension plan with long-term liabilities, you can afford to give up a little bit of liquidity in your portfolio to try to generate that. But as you'll see, that's where we're underweight. We're overweight to large cap. We are a little bit underweight to long short equity. We haven't rebalanced there, and it's not been up as much. We're comfortable with where we are there. Fixed income, essentially in line with targets. In real estate, the real estate portfolio has moved up quite a bit due to performance, and we did some rebalancing in real estate, adding to the Morgan Stanley Prime Property Fund, and you've made a couple of commitments there now, the Starwood Fund, and last month to the Angelo Gordon Fund, and those will be calling down capital over time. One manager note, I have mentioned Intech a couple of times. In the last couple of weeks, Intech underwent a management-led buyout where the team at Intech bought themselves back. They had been a wholly owned subsidiary of Janus Henderson. We've been seeing this happening in the asset management space more recently. Firms that got purchased 10 or 15 years ago are now being spun out of bigger firms, and the management team's owning them. You have the same thing happen with the Wells Berkeley Street team on your emerging market strategy. We don't view this as an issue. The Intech, the management team at Intech still remains intact. They're going to own 100% of the firm now. I think Regina received it's a consent to an assignment when the ownership changes effectively of a registered investment advisor. As an investor, you need to they need to get affirmative consent to the assignment of that agreement due to the change in control, and we would recommend consenting to that. Nothing's going to change with the management, the team, the strategy, so it was worth mentioning. With that, unless there's any questions, I'll turn to the asset allocation. And again, this is really just a review, no recommendations. You made some fairly substantial changes last year to your overall asset allocation, but we think it's important just to revisit this on a regular basis, to remind you about expectations, what's realistic going forward, and what to expect. So if you just flip one more slide, one more. There we go. I mean, this is basically what I just said. We want to review the portfolio's goals and objectives, revisit and confirm the current targets, and always important to focus on the long term, not what's going to happen immediately. But, as I think I've said before, you have to go through the short term to get to the long term. So we want to be comfortable getting the path that we take to get there. The next couple slides are, you saw these last year, and it's just reiterating what I've said. We're at a different starting point today than we were 10 years ago. This is showing the valuation of the equity markets, the PE at the end of a point in time, and what the trailing 10-year return was after that. So where we are today, or at the end of the year, PEs have come in quite a bit in January, but where we were at the end of the year was a valuation on the S&P 500 over 25 times earnings. So historically, that's very expensive. Going back in time, periods where the valuation or the PE on the S&P 500 has been that high, the next 10 years, the return for large cap stocks has been around, that's on the vertical axis, 5% or less. So the starting point is just it's not a good indicator for what to expect going forward. And the next slide looks at fixed income, similar story. The best indicator of returns on bonds over into the future is the starting yield, where we're starting from. I mean, if you bought a 10-year Treasury bond today, well, today it was almost at 2%, and held it for 10 years, you're going to get a 2% return. There can be some trading benefits in the interim, but effectively, the return on that bond over the next 10 years is going to be about 2%. This is the yield on the aggregate index, and you'll see where we are today. It's actually better than last year, up almost 100 basis points, but in terms of history, we're still at very low historical yields. So bond yields low, stock valuations high. That's not to say that all markets and everywhere you invest all look the same. In the next slide, or a couple slides here, inflation, something we haven't talked a lot about the last really decade because inflation has been low, but it's not something that we haven't considered in your portfolio. From a strategic allocation standpoint, equities, which are your largest allocation, or stocks, tend to perform well in a rising rate environment. You have 65% in equities. Inflation, companies have the ability to pass costs through to their customers over time, so that tends to lift up profits. When you strip out inflation, the impact real return might be a little bit lower, but the overall stocks tend to do okay in a rising inflationary environment, as does real estate. One of the primary reasons to have an allocation to real estate is it provides a long-term hedge against inflation. As costs go up, you have a diversified portfolio of real estate in office, multifamily, industrial, retail. As costs go up, those leases that you have in those portfolios, and they're not very long-term leases. You constantly have new leases running off and having to release. The property managers are able to lease at higher rates, so it provides a hedge against inflation. Certainly bonds are impacted by inflation and rising rates, so it is something. It's been considered, just because we haven't talked about it as much. It is in your portfolio. And then the other component on the equity side is the active managers have the ability to allocate, to reposition and allocate to sectors that will benefit more from rising inflation, materials, commodities, and other areas. Just turn to the next slide, Regina. So here we list our capital market assumptions. This is what you saw, similar to what you saw last year. We update our assumptions on an annual basis. The assumptions, there's really three components to our capital market assumptions: return, risk, and correlation. We're not showing the risk or correlation on here, so that's the higher the return, the higher the risk of an asset class. So these are median expected returns. The higher the range around that in any one year is pretty wide for the higher returning asset classes. Correlation, which we won't get too much into, but that refers to how various asset classes behave in relation to one another. So sometimes you can put a riskier asset class, add a riskier asset class to a portfolio, and it actually reduces overall portfolio risk because it's the way that asset class behaves. Core real estate has a very low correlation to equities and bonds. It acts as a diversifier. Private equity has a lower correlation just because of the nature of how, from an accounting function, it has a fairly low correlation to public equities. It lags public equity, so you're getting some benefit there. But what you'll see here, much like last year, we develop intermediate and long-term assumptions. So the intermediate assumptions are anchored more on current yield and current valuation. So from year to year, those will move around a little bit more. The long-term assumptions, and these are looking out 20, 30 years plus, which are relevant for a pension fund, they're anchored more on long-term historical averages of the asset classes. So you'll see a bit of a difference. But in the intermediate term, what you see here in the middle column, our large cap equity assumption is 6.5%. That first column is what large cap equity has given us the last 10 years, 16.6% over the last 10 years. So it's done so well that we're expecting some reversion to the mean. We're much higher valuation. Emerging market equities, the last 10 years have been okay, but certainly not in line with expectations, about 6%. Valuations there aren't nearly as unattractive as they are in the US. So our return assumption going forward is a little bit higher. If we look into the fixed income assumptions now, regardless of the category, core bonds, which is your passive strategy, core plus, which is a predominant allocation through Western, liquid absolute return, which is the PGIM strategy, a little bit higher, but our expectations are really in the 2 to 3% going forward. So if you just roll forward one slide, I think, there we go. So what we're showing you here is just to level set expectations again. The current target, this is your current policy target. We show the prior target just to remind you, you did make some substantial changes last year. This was your strategic allocation as coming into 2021, and you made some changes there. We actually made some changes, I think, in 2019, increasing real estate as well. But last year, we made a pretty substantial long-term change in lowering fixed income and increasing equity by 5%, and that was really going into private equity. As a reminder, we're showing you what the median outcome was. So that median return that you see in the middle of the page, 10-year median return, that is looking out over the next 10 years, there's a 50% probability of achieving that number or higher, and a 50% probability of achieving that number or less. We're not saying this is the return you're going to get. It's a probability-based number. Over time, the range of outcomes around that median will narrow. In any one year, the range is pretty wide. But last year, based on our capital market assumptions, your new target, the 10-year median return was about 5.5%. And looking out over 30 years, it was about 7.8%. You'll see that it's actually gone up. It looks a little bit better. The median return now, based on our 2022 capital market assumptions, is 6.25%, and long-term about 8%. Why is that? What got better? You just told us that valuations are higher and yields are low. Well, incorporated into this is also inflation. So our inflation assumption has gone up by about 75 basis points in the intermediate term and a similar amount in the long term. And valuations, while still high, at the end of 2021, a little bit better than they were at the end of 2020. valuations at the end of 2021 a little bit better than at the end of last year, and yields a little bit higher. Still low relative to historical, so it's bumping this up a little bit. Again, this is really a means just to level set expectations. If you go forward one more page, again, just looking at this, I think probably when you're thinking about your return assumption that you're setting and at 7%, if we look out over 20 years, that median, based on what the model does, what our simulation model does, it blends the intermediate assumptions and the long-term assumptions. So the further out in time you move, it's going to be utilizing the long-term assumptions more, which are a little bit higher. The first 10 years, it's only using the intermediate term assumptions. But you'll see the range of outcomes around that median narrows over time. Over 20 years, the 50th percentile probability for your current mix is at 7.7. I would, I think it's probably fair to look at the 25th to the 75th, and what we're really saying is there's a 50% probability that you're going to be somewhere between roughly 6 and 9.3% over the next 20 years. But that 7% is safely, there's a pretty good probability over the next 20 years of getting there. If you just go forward one page, this looks at it a little different. This looks at it in terms of probabilities, what I just said. So saying a 7% hurdle rate, which is what your assumed rate of return is today, over the next 10 years, and this is where I said, the path getting there may be more challenging. Over the next 10 years, the probability of having a 7% return is going to be much more challenging. The probability is about 40% because of where we are. Over 20 years, higher probability, it's about 60% for your current mix, and over longer term, higher. The next couple pages just look at what others have done and what's gone on in the market. This is a survey done by NASRA, the National Association of State Retirement Administrators. This chart's a little bit difficult to read, but basically what it's shown is state and local pension funds over the last 20 years have really been bringing down their return assumptions across the board. So if we look at the left, in 2001, that blue section, that represented a return assumption of 8%. So a big percentage of plans were using 8% as their return assumption. If you come over here to the right, in 2022, hardly any plans are having 8%, and very few have, between 7.5% to 8%. The majority of plans are in that 7% range as the median. And I think that the actual median is 7.26% at the end of 2020. That's the next slide. This is a survey done by NCEPRS in 2020. With NCEPRS, National Conference of Public Employee Retirement Systems, again, similar association to NASRA, just surveying their state and local pension plans. And you can see these based on size. It's kind of across the board, but really the median as of the end of 20 was 7.25%. So I think you can feel comfortable where you are today, both based on expectations over time and what others are doing. I think it's, you can't just anchor, assumptions are just that, they're assumptions, but they do impact other things. Funded status, the contribution rate, being thoughtful and bringing that down when your funded status is strong is beneficial. And so I think you guys have done a really good job of being diligent with that. And I think that 7% where you are today is certainly supported based on our intermediate and long-term assumptions. So again, no action to take on this. This was really just to provide information. Assumptions up a little bit from last year because inflation is up, but still next 5 to 10 years not going to look like the last 10 years.
Any questions for Jason? Hearing
Don't have a question, but I do have a comment. Jason, I think one of the reasons why we make good decisions is because your company guides us so well. I really enjoy the market letters, the spot market letters that come in, which, if anybody hadn't read that, has a really good kind of drill in, maybe a little bit more in depth of what you're saying with, an international large caps versus the U.S., how they broke that out, split that out, and it really opens a person's eyes to why in the world do we keep investing in international stocks when U.S. stocks are performing so much better? But when you look at what you just pointed out, U.S. stocks, there's just a handful of those that's really driving that market. And then you look at, your newsletter
Opportunity set.
points out some of the things that could flip that, how overpriced they are right now. That's a consideration, what would happen if that went the other day. Some of those companies may be on the governmental side of it, might be looking at a breakup because they are somewhat monopolistic. And so there's risk in there, and if that, as the newsletter shows, if that ever flips, then your internationals really would probably be the better stocks to be in. So right now, while we're diversified out and we're buying those internationals while they're undervalued a little bit more, and that's always a good thing to buy low and sell out high. So thanks for pointing that out, and I'd encourage anybody to take a look at that newsletter. It's really quite informative. That's all I have.
Okay, Marty, thank you. Chair will entertain a motion to accept the reports. Have a motion and a second. Please record your vote. Item is approved. Okay, item number 12 is comments from board, staff, and citizens. First, I'll take any citizens. Okay. Obviously, it goes without saying that a week ago today, we lost Jim Williamson. I don't know. I worked with Jim for almost all of my 34 years with the city, and I would put Jim in the top 2 or 3 individuals that I've worked with at the city as far as his ethical standpoint, his morality, and just being a downright good person. And as I said in the email that the board members got, that I will miss his sense of humor. He was just a good guy, and the city is a far better place for Jim having worked here. It's I don't know, folks, it's just a gut wrencher. It is just a gut wrencher, and unfortunately, during my tenure, we have lost a number of good people way too early. And unfortunately, we've got to add Jim to that list. Services are next Friday in Norman. I know Regina sent out an email asking about if anyone wanted to contribute to sending some flowers, but she informed me prior to the meeting that now they're asking for donations to the regional food bank. So if you'd like to do that, I know that would be entirely appreciated, by his wife and daughters. And I'll work with Regina. We'll put together a resolution for next month's meeting for Jim. Hopefully, we can get his wife and daughters to attend. But again, it's just sad. And if anyone else would like to chime in, feel free.
Yeah, Mr. Chairman, I would like to comment on that, you know, how many good things can you say about Jim? He was just that guy. He was probably the most ethical guy that I think I've ever known. And I leaned on him for those things and many times. In fact, when I was wanting to run for this board, I contacted Jim and I had, Jim, you know, I was thinking about putting some emails out to send out to the city employees. You think that would be okay? You know, am I kind of using city assets okay? And, you know, Jim came back and he didn't have a favorable ruling for me, but, you know, he was always good and solid. You knew his answers were right. And you know, like I say, that's just something I leaned on him. You know, a very good counselor once told me, he said, Marty, you know, God doesn't waste any pain. And as I reflect on that, you know, it's hard to lose somebody like Jim, but when I look back on the influence of him, and I have other stories about his ethics and just his demeanor, his personality, you know, that's the lesson. That's the value of Jim being here on this earth, was to share with me, you know, a way to live your life. And that's the memory I'll take with Jim.
Thanks. Anybody else? Okay. Thank you, everyone. We are adjourned at 10:47.